morning in the presentation of Minergy's results for the year ending June 2022. Just a few house rules how we will proceed. The presentation will be recorded, and a copy of the presentation will be made available on the website post this morning's presentation, so you can pick it up from there. To make sure that it's a fluent meeting, I would suggest that if we could keep answers to the end, it would help me to go through the presentation, and then we can address the questions that you've got right at the end together. So if that is in order with you all, can I please get a confirmation that you can see the presentation on your screens? Thank you. Right, so as I've mentioned, we are presenting the results for the year ending June 2022. It's been quite a tough year for the first 9 months. We'll talk about all the detail as we go through the presentation. But then we've had this significant market turnaround in the last quarter, which has basically changed all the dynamics for Minergy and steered it on a path of profitability and going forward. So we're very excited about that. We'll talk to you about some of that. As I said, unfortunately, the bulk of the results, the first 9 months have been impacted by certain factors, which I'll share with you. So that just as an introduction, welcome to you all. There's our typical disclaimer to share with you. So in terms of an overview for the year that's passed, if we break it down into a funding and operational and a market and sales categories, from a funding perspective, and this has been well announced, we've concluded, we've received our final funding from the MDCB in July 2021. Remember that they approved a loan of 125 million pula. Half of that was received in December 2020. The remainder was received after fulfilling certain conditions in July 2021. So there is that debt that's coming to the business. And in addition to that, to ensure that there is stabilization of the business, a debt restructuring was into between the MDCB, the BDC, and the mining contractor in terms of allowing the business certain waivers and graces in terms of operating, in terms of stabilizing cash flows and allowing the business to survive the difficult times that was going through. So we're very grateful for those fundings and debt restructurings which have been concluded. In terms of operational feedback, we have also announced that we completed our what we call stage 4 of the processing plant. Now, stage 4 is the back end of the plant, or the product screening and stock handling section. The complete plant construction is now complete. That was completed in about October. And we've seen significant benefits of a full operating plant compared to the way that the plant was constructed in terms of using mobile equipment initially, with its disadvantages, but also advantages in the sense of Minergy getting a footprint into the local market and producing coal and showing people that coal is of a good quality. So for the year that's passed, we've had very good turnarounds in terms of mining and our feed to plant. We've achieved significant records. I'll take you through that as well. Most of it has been driven by the last quarter of 2022, catapulting us into the production capacities that we set ourselves from the start. Market and sales, you all should be familiar what's happening in the markets, but typically for ourselves, the first 9 months was quite difficult in terms of evacuating coal into South Africa. There was an oversupply of product in South Africa as a result of Transnet's inability to rail. We've had customer breakdowns at their facilities, especially key contract customers, twice during the year. That's impacted the numbers. We had even had some freak rainfall in April that closed the mine for a day or two. We still struggle with intermittent power outages, albeit that we are electrified. But everything changed in the last quarter when the Ukraine war happened. Now, I'm the first person to say that nothing good can happen from a war, but the energy crisis that's resulted from that has really benefited Minergy and any other coal producer for that fact going forward. I've spoken about what's happened with coal prices internationally. We typically track the Richards Bay coal pricing, RB1, RB2, and RB3s. So these prices are slightly lower than the Newcastles that you will see, but the trend is the same. We had a peak of $425, $430 in March when the war broke out, and then subsequent to that, it's been quite good in terms of the pricing that we've seen. Very stable. This is the Newcastle price. The RB1 price is slightly lower, as I said to you. That's quite stable at about $330 or $320 at the moment. Very, very good pricing. At those prices, even a landlocked country like Botswana can make economical sense of our logistical costs. So, as mentioned, the fourth quarter set the tone for recovery to profitability, and that's the path that we're on for the 23 financial year. In terms of our operational review, again, all the hard work that we put in over the last 3 years has culminated in us now achieving production capacity. The capacity is now proven and the environment is stable. Just as always, and most importantly, health and safety remains a key parameter for us and a key area to manage. We've got an outstanding safety record. Really, really proud of what the guys have done on the ground. We have a minor lost time injury that occurred in August last year. Other than that, since inception, none. And that's testament to the health and safety programs that are implemented at the mine. As I said, health and safety is paramount in management. We are not free from COVID. Unfortunately, all businesses have been experiencing some kind of effect of COVID. It's quite strange how you quickly forget how tough it was in 2020. And we're now 2 years later down the road, and COVID seems to be some kind of bad nightmare. It's still real. It has consequences on businesses. We are very grateful that we've survived it, thanks to our stakeholders and the sacrifices that's been made. So from our perspective, and from a record perspective, we've only recorded 146 cases, which is significant for our mine, and 86 of those occurred in the last year. There was a spike a month or two ago that we've managed, but because 97% of our workforce is vaccinated, the impact on the business, the interruptions and the like, is minimized, and we're able to continue as normal with regard to that. You'll always, I guess, in terms of unvaccinated staff, have the group that believe they shouldn't be vaccinated, which we respect. But in our case, 97% is a very good percentage for us. You can also see the growth in staff from 2021. And, if you take 2019 as a startup year, we started with 62 employees. So I think in terms of our mandate to employ local and contribute to the decline of unemployment in Botswana, Minergy has significantly contributed to that. We're also very happy to have added a female as in a senior position, our process engineer, the lady there in the red jersey there, is part of the team, and she's our process engineer. Very happy to have her on board. So health and safety, very happy with the progress made, remains a key facet of the business to be managed. The other issue that remains quite tricky and quite sensitive, and rightly and wrongly, unfortunately wrongly, we've copped some bad press about that, is the dust suppression that is required. Now, we are continuously trying to maintain a public road. It's not our road. It's owned by government. It's under the administration of the Department of Roads. We basically have just given up in maintaining this road and left it to private parties to maintain the road. So we've been doing that. It is in our benefit, as you can understand. the cost is it's very costly. 10 million pula has been spent in the financial year that's passed, compared to 6 million in the prior year. We do that so that we can maintain the road, so that when we do have rainy seasons and the like, that the road can cope with the extra loads. You can appreciate with the additional volume that we're putting through, the road is going to take a hammering. Very happy with the standard of the road. If you haven't been out that side, the road started off as a donkey track many years ago. It's one of the best maintained gravel roads in the area. It's still a gravel road and it still creates dust. So as part of our commitment to the communities, sensitive areas within the villages, past schools and the like, past farmers that are farming very close to the road and so forth, we make use of dust suppression. We also put in speed humps in certain areas to minimize, speed and traffic calming measures. So that, I think, is a step up for us from the prior year. Again, confirming our commitment to maintaining that specific road. For us, the first prize and the best prize is to tar the road. We are in a position to tar the road, but it is quite costly. And we have reached out to government through the various organs to create a triple P to tar the road. Unfortunately, everything goes very slowly. I am not sure how much funding government has got available to assist with that. So this may be a project that we have to take offline and fund it ourselves, and then, see how government can contribute in the future. But for us, it's a key, especially with the growth that we're foreseeing, and it will obviously take away the dust problems and make evacuation from the mine much quicker, and that will also give us a benefit potentially in getting better transport rates in terms of wear and tear on the trucks. So key for us to manage, and we'll keep our focus on that. From an operational performance perspective, the graphs are all going in the right direction. We started showing you some of these graphs last year. So from an overburden perspective, more than 4.5 million cubes moved for the years. It's basically more than FY20 and 21 together. So we've done extremely well. FY19 obviously is when we started the mine, and that included a lot of bush clearing and box cutting. So it's not purely representative of overburden moved straight from a coal extraction perspective, but very good record. The trend has continued into the new year. In a single month, we've actually moved 1 million cubes in the 2023 year. So with a new and additional mining fleet that we've established, you'll see that the benefits are going to be there in terms of overburden removal and coal. Both coal mined and feed to plant have now reached the 2 million marks. And what is significant is that 1 million of that was achieved in 2022 in a single year. So we're very proud of that record. That is, again, contributed to the commitment by our contractors, which we are very grateful for. And again, it is supported by sales in the market. So a majority of this growth happened in Q4, let's say about 40% of it. But generally, in the year that passed, we were surpassing the prior years, ton for ton or cube for cube. Again, as an overview in terms of operations, I think it's important that we completed the plant. The plant was the bane of our existence in the sense that for strategic reasons, we had to start the plant in its infancy and bring it through the stages to take advantage of the market and capture it, which we've done successfully. But it came with problems like product fractions that were not economical, excess water usage and the like. So the plant now has supported nameplate capacity. We are also seeing water savings of about 33% in litre per ton for the year that's passed compared to the prior year, mainly because of the full plant operating in unison, but also you've got the water saving mechanisms like the dewatering screen, the filter press, and then on the screening side, we also have a dewatering screen when it comes to the fine product where water is recovered. We probably recycle 70% of the water. Not that water is a problem that we've now completely solved. We live in a very dry country. Water resources are very tight. There's not a lot of surface water. And if you're not in the right area, you must make use of boreholes and so forth, which has got implications on the farmers around you and so forth. So there are some plans that we are putting in place in terms of a sustainable water source, but it requires assistance from government, and we are starting with those processes. I have mentioned the single year records in feed to plant and mining. Very proud of that. And operationally, we still struggle with the supply of electricity. Now, this is not load shedding like we experience in South Africa. It's localized. BPC needs to maintain the line. Remember, we paid for that line coming into the mine, just spin-offs for the community. So there is intermittent breakdowns that we need to manage through them. So the relationship with BPC is good. Their turnarounds are quite good, but we do experience that. So all in all, operationally, plant ready to support nameplate capacity or supporting nameplate capacity. Mining team is doing extremely well. I guess the automatic benefit of all the additional volumes is sales, and especially as I've mentioned to you, Q4 has been significant in contributing to the numbers. So again, you can see the trend of sales. We're nearly at the 600,000 mark just for a single year. Remember that beneficiation. We don't sell one ton of coal extracted. There's a beneficiation process that takes out the impurities, and we wash through a yield. That's why you won't see like for likes. Very good performance again for a startup greenfields operation. Basically in its third year selling, to have already surpassed 1 million mark cumulatively, a very good achievement in difficult circumstances, including COVID and the negative narrative in terms of investing in coal and the like. So very pleased with that. More pleasing is our product mix. You've been familiar with discussions we've had in the past, where the blue slice, which is the duff, used to be a number in excess of 60 to 70% of our product mix because of, let's say, the configuration of the plant at the time. You'll see that numbers come down to 40%. The more economical products, which is your peas, has now grown to 34%. It was a very low number in the low teens in the prior year. So very pleased with that change. And obviously with that comes many benefits, better average pricing and profitability, as these products are selling at much higher price than cost. So product mix objective achieved, again supported by the plant and management on the ground. Just into what do we sell our coal? You'll see there's no sales into any power generation yet. So there's no sales to a power station either in Namibia or South Africa in here. So for the year that's passed, that is where the sales have gone. Cement industry typically remains a big component of the business, and it's because of logistics, locality just across the border. So that remains an important contract and customer for us. However, you'll see that we've had some steel makers come into the fray during the financial year. Very pleased to bring them on board, quite a big percentage, and that is continuously growing. And then I think the number that nobody expected to be on this graph is seaborne export. So where does that go? Well, it probably does go into power generation, but it doesn't go into power generation in Europe. In Africa, it goes into Europe. So the vessels that we've done, and we'll talk about those, has been done through Walvis Bay, and it is used in Europe for whatever usage they have. So, if you told me that I would present a pie chart to you with a component or an industry that we're supporting that is not on this continent, I would have told you that you are smoking something. So we're very pleased to report that, and that number will increase in the year that's ahead. From a geography perspective, again, South Africa has always been around the 80% for the sized coal going into the cement and steel markets and also the trade or the industry markets. But Namibia has become a bit smaller, but it's because of fractions. The 14% exports, as I've explained to you, going into Europe now is quite interesting phenomenon for us. So that's just a breakdown of our sales. International exports, again, these are real photos, people. These are not taken from the internet and copied and pasted. These are our vessels that left Walvis Bay as at the end of June. We've done 2 FOB vessels, probably about 70,000 tons on an FOB basis. We've also started railing coal at the end of June into Maputo on a free on-rail basis. Remember, we've got access to our siding. The logistics cost still makes it worth our while to go to Walvis Bay. It's easier for us to access Walvis Bay than, let's say, the shorter routes to Durban. Durban and Richards Bay remains congested, and it's a bit of chaos there at the moment as everybody is running towards that. The rail route to Maputo is also being pursued, I know, by Marapule. They've done a few more trains than us, but apparently they're happy with turnaround times of between 15 and 20 days. That doesn't work for us. So it's easier to get coal to Walvis Bay than to Maputo on rail. The rail option is unfortunately through 3 jurisdictions. You have to appreciate that POTRAIL is only one party. Then you've got the National Railways of Zimbabwe, and then you've got CFM from Mozambique. So all 3 need to come to the party. Unfortunately, there is a bottleneck and a problem on the Zim side, which makes turnaround times not economical. But the options are pursued. Many private enterprises are offering their assistance to help with that. I'm just hoping that those government institutions, all 3 of them, are willing to take that assistance and not, protect their little ivory towers. In terms of finances, all the good news in Q4, unfortunately, doesn't result in the numbers changing from the prior year. We've had 9 very difficult months. So the results, which was presented on X News, obviously shows the losses that we've incurred for the year. But the pleasing trend is that there has been a turnaround, and that's what we are focusing on. So there's the income statement. I'm going to dissect it a little bit more for you. So you can pick that up on the X News, but it will be available on here. Basically, a significant increase in the revenue and cost of sales, which I'll talk about. And then I think the one that is of concern to us is the finance cost component that is so high in the absence of getting equity into the business, bringing us to a loss of about 131 million versus 106 million in the prior year. But let's look at it in a bit more detail. I need you to strip out about 128 million out of coal revenue and cost of sales. It is the cost that we recover in terms of transport, road transport, rail transport, and then FOB related costs, because we have obviously delivered 2 vessels on an FOB basis. That includes port costs, port handling costs, and various transport costs around getting the product to the ports. So that item is reciprocal in both. So if we look at pure coal revenue, it's increased with 77% from a value perspective. That's driven by volume increases of 40%. We touched on that on the graph that I presented earlier. And then more pleasingly is the 26% increase in pricing. Now, again, on an average basis, we were doing a little bit better than the prior year. But again, the mix of the products only supported, let's say, the more or less economical product fractions until we had the swing around coming around in Q4 when we started delivering, coal onto the vessels in Walvis Bay. So just that in the last 3 months swung everything around to give us this fantastic increase of 26%. In terms of cost of sales, you would appreciate that there would be an increase in cost of sales as well. We've touched on the increase in mining volume, 54%. P2 plant, has increased with 49%. So those variable cost items would have, pushed the cost items higher. We've also had increasing cost pressures. None of us have escaped the higher diesel prices. We consume a significant amount of diesel, and diesel has increased with 127%, explosives with 57%. So we, as Minergy, are responsible for paying these costs. It's not for the contractor. So that obviously adds to your cash flow woes. It also pushes up your cost of production. If you combine that with double-digit inflation, which is abnormal for Botswana, you can appreciate that your cost per ton would have increased, over the period that is being presented. We've also increased our spend on road maintenance. I've touched on that earlier, for the right reasons. And then government has also benefited from the increased royalties from the increased sales. So all these numbers go into increasing your pure cost of sales number. So I would look at it in that perspective. If you look at the 425 million that's been reported on the income statement as revenue, you need to strip the 128 out, and vice versa, the cost of sale components. So please do that if you want to do an evaluation of pure gold trading. So what is new for us is that with the implementation of the dewatering screen, we were able to capture the -2 material, and which would typically go into discard, and that would have just been written off. What we do now is, in the process of taking out the raw fines, we are recycling water, but these fines are also of such a quality. It's not washed. We call it raw fines, that the cement industry is quite key on taking it. Very, very low revenue item. So that's why we don't classify it as sales, a byproduct. But that has contributed to our what we call sundry income, and that is becoming quite a good seller. We can take that product and have various benefits. You can sell it as is. And secondly, we also blend it into the raw material, because into the finished product. The finished product sometimes comes out at a higher quality, and you blend it down accordingly. So your yield improves, and also your let's say your cost per ton recovery increases. So that's a positive impact on the income statement, and you can keep on watching that number going forward. The trend to decrease operating expenditure continues. There's a further 13% decrease from the prior year. Again, cost management is in difficult times a very important priority. We are still thankful to staff, senior management, and the likes who's taken salary sacrifices in terms of this in difficult times. So never mind that the staff doesn't get bonuses or incentives. They even have to sacrifice their salaries, but it just shows you the heart of the team in supporting the business. I'm very appreciative of that. We are busy rectifying that. Staff have done extremely well. That gives us then an operating loss of 74 million pula. That's 13% lower than the prior year, which I think was around 85 million. So again, if you look at the numbers we've reported for the first 3 quarters, this is a operating loss break even for Q4. So that is phenomenal that the bulk of the losses were generated in the first 3 quarters, and we've stemmed the tide there. If you look at it from an EBITDA perspective, taking out the depreciations and all the fancy IFRS adjustments that's got to go through the accounts, the number comes down to 58 million, which is also lower from the prior year, which I think was around 75 million. That's a 22% decrease. And if you compare it to 2020, it's a further decrease of 30% from that number. So I think we're on the right track. Again, what is important to us is the fundamental change in what's happening with the business. We've been struggling, as you all know, but from an EBITDA perspective in Q4, taking back depreciation and the likes, we did show a profit. Now, these these type of numbers are supported again into the financial year, in the new financial year, and it's purely driven by volume. So nobody here will disagree with me if I say to you that coal is a volume-driven business, and we've always had to get to nameplate capacity, go past break even, and then profitability will come. Well, we are there, ladies and gentlemen, and we are very pleased with the turnaround. So that is from an operating loss overview perspective. Again, cost of sales, the three main items, or the two main items remain mining and beneficiation. Mining has gone up from the prior year as a component, but appreciating that diesel and explosives take up probably about 31% of cost of sales on its own. So it's a big component of mining cost, obviously. So that number has increased from the prior year as a result of the increases that we've seen being put through, which is the other side of the energy crisis. Other cost of sales, it's overheads, which have basically come down year on year. Royalties has increased, as I've explained, on the higher sales. Road maintenance has also increased. And then depreciation has also gone higher from year to year as a result of more mining and the allocation and appropriation method used. The biggest problem on the income statement, now that we've solved profitability, remains finance cost. And in the absence of equity, this is the only way that we could survive the business. We're very grateful to our partners, which includes our mining contractor, MDCB and BDC, that have been willing to debt restructure the business. And then also, provide us with the funding through difficult times. So here's a waterfall graph showing you what the main components of the difference is. There's an additional 43 million finance charges that's come through for the year, nearly doubling from the prior year. The bulk of it relates to the MDCB funding. If you see the 10 million here, that relates to the new funding that was received in July. But in the comparative, this number here, we only received that money in December 2020. So the full year effect of that interest was not prevalent in the prior year. So that's 16 million relating to, let's say, the MDCB. We in the prior financial year also had the small component of borrowing costs that were capitalized. That practice was ceased in December 2020 already. So that 4.5 million is relevant to that. As part of debt restructuring, the BDC increased their coupon. So that's contributed to finance charges. And then our mining contractor, Charcon, has taken some of their debt, made it senior debt in terms of the debt restructuring, and also deferred some mining costs. So that interest is running on the back of that. Typically, and until we stop the avalanche of the debt in the business, the compounding effect on year and year is just going to grow more and more. So the restructuring of the company's capital structure is key in terms of the year ahead, but I'll talk about that going forward. The statement of financial position, again, you can read that at your leisure. I think the important items I just wanted to highlight you quickly is that you'll see there's a massive jump in property, plant and equipment. It's completely all non-cash flow. The rehab liability on this line item here has doubled, and accordingly, a reciprocal asset has been created for as IFRS requires. So that is the bulk of that. Other than that, and you'll see it in the cash flow statement, minimal capex being spent, as most of the capex on the mine is adequate for production performance. Doesn't mean that we need more capex to do things better and smarter. But any other capex mainly relates to the search for water, additional boreholes that we have to drill and so forth. So just highlighting that to you, and then the residual would be obviously depreciation that has increased year on year. So non-cash flow increase in PP&E. All your working capital items will have increased, and specifically happening around the back end of Q4. So we were sitting with excess stocks at the end of February because of the market situation that we were facing. Then the war happened. We liquidated all those stocks, but an investment was required in terms of working capital, building inventory in terms of work in progress in the pit, which means we have to strip ahead. Otherwise, you won't have coal exposed. So the bulk of inventory relates to work in progress, stripping ahead. Inventory on a finished goods perspective is minimal. Run of mine is minimal. We're basically producing and selling at the same time. So very just in time. Product doesn't sit on the pads, and very low quantities and volumes of stock stuck in inventory. So that is only work in progress that's driving that number. Trade and other receivables, again, with the significant increase in sales in the last 3 months, you will appreciate that that number will increase. None of that is problematic, and the bulk of that has been collected already post-year end. So quite happy with our credit management. Typically, we allow 30 days for credit risk items which we are not comfortable with. There's prepayments, cash on delivery, and on the export deals, we also work on a basis where we get prepayments to assist us in terms of our costs. So much quicker than the 30 days, and it works well for us. The rehab liability I've spoken about. In terms of borrowings, I've got a slide for you on borrowings. There's the breakdown of the borrowings on the right-hand side, just showing you, where the bulk of the debt is. So it's lying between the BDC and the MDCB with the new debts that come in. And then JARCON is obviously a new debt provider in terms of debt restructuring. That's done the residual restructuring for us. Debt equity, we'll talk about that. Very low. I'm not doing a accounting calculation here. I'm doing a straight debt equity, taking out accumulated losses because it's negative equity. And those are, the low numbers. Again, it is a function of what was available at the time. So we need to change that soon. Cash flow from the business, you can see where the cash has been appropriated. I think the important number is that cash utilized in operations is driven by a significant increase in working capital. You saw the numbers on the balance sheet. If you just do a straightforward comparison, which I don't like to do on a balance sheet, there is a 91 million swing in working capital just from year 1, 21 to 2022. So significant investment there. The rest is all smaller, and the bottom line is that it was funded by the borrowings that we've received during the year, which includes the MDCB funding, the JARCON funding, and the like. So in terms of going concern and liquidity, we are now operating at our production capacity of 125,000 tons. We've got a stable plant. We've got export opportunities. It's a time in the coal market that's never been seen before, and which favors better product and pricing mixes. So profitability is now being pursued and achieved. We know that there's an unhealthy weighting in the capital structure towards debt funding, and that needs to be addressed. How do we do that? Well, there's some of the debt agreements that are extremely punitive in terms of coupon rates. We need to look at the refinancing those. We are still looking at placing the approved equity of 125 million pula that was available and approved by shareholders in 2021. The promising aspect here is that the negative narrative around coal has changed, where we were not even entertained as a conversation or just immediately shown the door. We had to beg people to see us. Now we are being pursued by investors, specifically offshore, in looking at maybe looking at some kind of way to secure a stable supply into Europe. So we're very happy with regard to that, having some very interesting conversations. Nice to be on the other side of the table where the conversation is positive. The conversation doesn't go about Minergy justifying why coal is required, which it is. It's now about what can we do for you and help you. So hopefully we can put something in place within the next 6 months, and that would be a combination then of let's say debt that we will refinance and then equity that we'll place. We are still pursuing our equity adjustment, our international exchange. We believe there is an opportunity for us to again make, take opportunity of the opening of the window in terms of coal, which is positive at the moment, and that will give our shareholders then an opportunity to have a more liquid market than the Botswana Stock Exchange. So that's from a going concern perspective. Value add, just what we do in terms of employment cost, taxes into the government, and royalties. We've touched on that before. Community involvement remains important to us. We have stepped up our public relations game. Happy to have partnered with a local PR firm in conjunction with our investor relations service provider in South Africa. We've produced this brochure, this Minergy Cares brochure that you see in the middle of the presentation. Please go to our website and download it there. Really, really informative about what Minergy has done. Minergy has been very silent about the help that it does and the effort it puts into the community in terms of jobs that's been created, electrifying villages that wouldn't have had electricity for a long time, the peripheral businesses that shoot up as a result of the mine and the like. So it's not all bad, and I think it's important that we become public with what we do. Again, 96% of our workforce is local, in line with our mandate from government to support a local industry. We've spent 488 million on local procurement. That means companies that are registered in Botswana. It doesn't mean that the shareholding is necessarily local, but that is still going into the fiscus. And we have a citizen economic empowerment plan in place where we focus on various issues. But the one that we can make the biggest difference is supporting local transport industry. We are making use of 22 local transporters compared to probably 3 or 4 last year. So you can see, those businesses are being supported. So some of the photos there shows you the clinic and the participation we have there. But please go download the brochure. I think it's extremely helpful. Let's talk about the lacquer stuff, the market dynamics. I mean, coal is like a phoenix arising from the ashes, literally. And let's have a look at that thing. And I think we need to look at the supply and demand sides. If you look at the supply side, and that's a very important focus area that a lot of people are missing on. Everybody is looking at demand and so forth, but supply is the main issue. It is constrained. There's no new investment in coal. As the narrative has gained traction, people have stopped investing in coal. So there's no new mines. There's old mines that are being mined out, and your supply pool has decreased significantly. So for somebody to start up a mine, it's going to take them a while. But I don't know how long the window is going to last, but you may have missed it already. So if you're in coal and operational, like a company such as Minergy, the benefits are many to have. The Russian supply is diminished on the back of international sanctions, and it's forecasted that the supply of coal with a high calorific value, which includes ours, will remain tight. Europe is in a very difficult position, and I'm not talking Europe only. Europe is a smaller component of coal users, but India has an opportunity to also increase, and China. So we'll talk about that. So if you look at the suppliers, they may be starting up new coal mines in the UK. In your life, have you ever seen something like that? The place where it was forbidden. It's like sacrilege. But anyway, South African output is also under pressure. So it's the South African guys have got a problem called Transnet, and the railways aren't performing, and it's still having the same issues. And last year they only evacuated 58 million. The difference from this year to last year is most of the miners are now finding, let's say, positive other ways to evacuate the product. So it now goes to the port by road. And it's one of the challenges we'll face, and we'll talk about now, is that, there can't be an oversupply in the market. There's actually an undersupply of market because that product that's now being produced is now evacuated to the ports, but by truck. So transit is, plodding along, and they'll probably do their 60 million, but they could have done 80 million. So that other 20 million is now seriously going onto road, which has got its own complications. Australia's got their own struggles, which means that the world is looking at some place where coal can come from. Botswana is, and we've said this many, many times, Botswana sits on 200 billion tons of coal, and it would be a sin not to evacuate that, as Honourable Minister has mentioned many, many times. I've just attended a conference here at Pakalani last week, and it was made quite clear to the audience that Botswana is ripe to take advantage of that. We know that there is other mines starting up. Marapule is increasing their output and so on, which is fantastic, which is good for Botswana as a coal industry. But this is 3 years too late. So let's hope that opportunity exists. The coal is good. The markets that it goes to are looking for a stable supply of coal. South Africa's got its problems, as I've mentioned, so why not Botswana? So that's from a supply perspective. Logistics is a key challenge. It's all about the availability of road trucks. It's all good and well that the exporters have now decided to truck their product to the ports, but all available road capacity is now also being sucked up by that. We've been informed that a major trader has even gone as far as buying out the fleet of one transport service provider for the entire year to make sure that they can get guaranteed loads. So, that remains an issue. We see that at the mine. We try and get as much product out. Our customers are responsible for transport, and they struggle to send trucks. If you have a breakdown, or even the mine is down for a week or something like that, the trucks go out of the cycle, and they lose access to the trucks. So continuity is very important to keep the trucks in the cycle. I think alternative ports are going to get much more business than they have had in the past, and I think there's been talk about Maputo increasing their output rates. Walvis Bay, which we've pioneered, is definitely they've gone from 0 to hero very quickly. We are currently busy loading our 4th vessel, so there is a great opportunity in terms of supplying from Botswana. On the demand side, there was already a shift in 2020 when China decided to stop buying coal from Australia. We know about the political interference and fights that they had. So that already put a new sort of direction on where coal was. So China was getting coal from Indonesia, Malaysia, and so forth, compared to Australia. Australia were then going into India, and that had some kind of effect on the South African market. But be that as it may, that's when the supply shortage basically started already. So a lot of people say, yeah, no, it's all happened with the war. It started last year already in terms of this shortage of supply. And then you'll see that the pricing was already in the mid 200s during those periods. So everything changed with the war. And again, you now have the different markets looking for coal. If you look at the EU, they need to replace very expensive gas. Their gas gets switched on and off, and prices are increased as Gazprom decides what they want to do. They need to find new suppliers. You've even seen, this world that was not keen on coal. They are now extending the life of coal plants that was going to be closed. They're reopening closed plants. They are raising caps on their operating hours to reduce gas consumption. It's just it's another world out there. The war might end, but will the sanctions end? We don't know. It's one of those questions. But as with COVID, the world has realized that there needs to be a re-evaluation from where energy is coming from, and it's very arrogant to quickly switch off coal and go to renewables. Always, as we've always said, coal is required for baseload, and switching off coal now, and it's got many consequences. And the wars again illustrated that. So not wanting to use the war as a stick to hit anybody, but it's the truth. Coal is here for a long time to stay, and we all want a greener planet, and that's important. So, just a little press release from the International Energy Agency that was already done in July 2022, and again they look at all kinds of energies produced into the market. Pricing all-time peaks. Three records between October 2021 and May 2022. There's supply shortages, and it's expected that these conditions are going to continue well into next year and beyond. We're very conservative and hoping that it's going to remain, like this until the end of June next year. From the conference last week, there's people saying it could be as long as 5 years. So we'll take that. But I think there's a reset in terms of thinking and so forth. India and China, they consume so much coal. It's like double the amount of coal the rest of the world combined. So what they do is important. India will grow with about 7%. China's currently facing COVID lockdowns, and when China does something, they do it, on a global scale. So there is a decline in their offtakes at the moment, but that's all going to change. We need to see what the winter is going to be like in Europe and in the Northern Hemisphere, and that will have a significant change on these numbers as well. So what is our outlook? Simply just in a graphical presentation like this, our production capacity is 125,000 tons per month. We're doing that at the moment. We're mining it. We're putting it through the plant. That gives us our saleable tons. That gives us, that is supported by the mining teams that are in place, and the plant's fully commissioned. We don't have a situation where we were still waiting for something to complete or invest additional capital. So Minergy is placed to take advantage of this. We know that there is a very strong demand for product. There's stable export prices, as we can see for the last few months, and looking forward, that will give us a stable cash flows, and then obviously EBITDA. Where's our opportunities? There are many, but these are ones that I've highlighted for you. We need to look at resetting some of the pricing that we're doing into the local market. The finer product still goes at a low price, and with a shortage of coal, there needs to be a reset, and it's across the board. And the cement industry is in for a bit of a shocker to align them with, let's call it, more export parity type of prices. We want to increase our seaborne exports significantly, and we've got the coal to do that. We've not unearthed the E-seam, which is of a higher quality, and there is a bit of cost involved to do that. But what we can do, we can, for example, mine additional raw coal and mix it with the E-seam to give us some additional product. So our bottleneck remains the plant, and the plant needs to be doubled up. Again, as previously explained, our front end, which is the crushing section, and the back end, which is the screening section, can already do double the capacity. The washing module is the one that needs to be upgraded, and it's also very, very dependent on water. And again, as I mentioned earlier, water remains tricky for us, and we need to manage that clearly. So you can't double up if you don't have the water. The other point that I've touched on is lower quality product. There is a market, especially the Polish and so forth, are looking for a lower quality product, which is probably par with our raw coal. So instead of beneficiating the product, you can sell it as a raw. But again, everything depends on logistics and how you can get it to the port and the like. So many opportunities, not without challenges. As I've mentioned, refinancing our debt, getting equity into the business is key now, so that we can take advantage of this. I mean, doubling our production capacity to 250,000 tons a month is a definite, and we need to be supported to do that, to take complete advantage of what's happening in the market. Right, that's about my story for the morning for yourselves. I hope you found that interesting. Happy to take any questions. Not all at once, please. Yes, please ask the question.
Good morning, Monet. So just my question is around the seaborne exports. So when you look at the business going forward, um, how I think first of all, how's the pricing between the pricing between the seaborne market and what you're selling regionally in SA and Namibia? And then secondly, when you look at how the business will be constituted going forward, what percentage do you think would be optimal for the seaborne market for Minergy? Thank you.
Yeah, thank you very much for that question. Good question. So number one, the optimal mix right now would be 100% seaborne export and zero local. Okay, but that is unfortunately not practical, and we need to look at supporting the market that has been supporting us for a long time. So I think it's a principle for Minergy to make sure that we look after those businesses that have done that. So an optimal mix would be anything between 40 and 50% from a seaborne perspective. Our challenge remains on logistics and how quickly can you get product to the bay. A vessel is anything between 30 and 55,000 tons, and it takes you, anything from 6 to 8 weeks to get product over a 1,500 kilometer period, specifically if you use Walvis Bay. If you want to load a ship in Maputo, it's difficult to give you an answer there because I don't trust the turnaround times of the rail operators at the moment. It could be anything from 1 to 6 months, and you can't build your business case around that. So, in terms of split, maximum 50%. Anything higher than that, we'll take it, but it comes with a proviso. Hence, something that I've alluded to earlier. The pricing in the local market has been very low for a very, very long time, and the cement industry has been benefiting from that, especially the South African and Namibian ones, from these lower prices. At the time when we started up, we didn't have a choice but to enter into agreements and make sure that we had, the necessary base to carry the business going forward. So we are in a position now to renegotiate most of those contracts. And to answer your question, is there needs to be a significant increase in their pricing, closer to export parity. That could be anything from a 50% increase, if not more. And it's some delicate discussions we're going to have without chasing the market away. But at the end of the day, their supply pool is so limited that you have an opportunity to do that. So there has to be an adjustment upward to bring those prices closer to that. Minergy is not in the business of selling product below cost anymore. So hopefully I'm giving you some guidance in terms of a change in strategy, wanting to support the local market, but it needs to be much closer to export parity prices. In terms of Minergy's business model, we sell what we call free on mine. We don't get involved with transport for various reasons. We're not transporters. We did our first 2 vessels on an FOB basis. It's too risky for us. There's too many things that can go wrong, and the working capital required to fund a 6-week period, especially transporters and their fuel requirements, puts pressure on our business. So we now sell still through Walvis Bay, but through an intermediary and back on mine. So our prerogative is to get an export parity price back on mine that makes us good money. I hope I answered your question.
Yes, you did. Thank you so much.
All right. Any more questions? If you have any further questions, I'm happy for you to reach out to me by email. As I said, the presentation will be available and the recording on our website, and you're very welcome to reach out to me. So that if there's no further questions, ladies and gentlemen, thank you very much for joining this morning. It's always a privilege sharing our results and our views with the market. I hope you are excited about Minergy as we are, and we look forward to reporting different numbers going into the future. So thank you very much for your attendance, And I wish you all a blessed day. Thank you very much.
Thank you.
You.
Thank you.
Thank you, Monet.
Yes.